Hey everyone, welcome back. Today, we're going to try something a little different.
Okay.
We're going to break down some complicated money stuff, but we're going to do it in a way that's like super easy to understand.
Yeah.
Like a crash course on investing, but without all the jargon, all that headache-inducing stuff.
Yeah.
Our guide for this deep dive is a book called A Random Walk Down Wall Street.
Oh, nice.
And it uses some really interesting stories from the past, like how people went crazy over tulips.
Really?
Yeah.
Like, what happened?
Traded their houses for them.
Oh, wow.
Yeah.
Yeah. That's
I
interesting.
heard that right.
So what's really neat about this book is that it explains how the market works
You got
in
it.
plain English, you know?
Yeah.
It helps you see why prices go up and down,
Mm-hmm.
and more importantly, how to avoid some common traps
Right.
that people fall into.
So the book talks about this thing called the castle in the air theory.
Oh, okay.
Sounds kind of whimsical, but it explains a lot about how people behave when it comes to investing.
Interesting.
Can you break that down for us?
Yeah, so it's basically the idea that sometimes people buy stocks based on, hype and rumors,
Right.
not because the company's actually doing well.
Oh.
It's like building a castle in the air.
Mm.
It looks fancy, but has no real foundation.
Yeah.
Remember the dot-com bubble in the late 90s?
Oh, yeah.
A lot of those internet companies had crazy high prices,
Right.
even though they weren't making any money.
So it's like getting caught up in the excitement
Yeah.
and forgetting to look at the actual value of things.
Yeah, that's a good way to put it.
So to illustrate this, the book uses this historical event
Okay.
called the Dutch Tulip Mania to show how this castle in the air thinking
Yeah.
can lead to big problems.
Right.
People were literally trading their houses for tulip bulbs
Oh, wow.
because they thought the prices would just keep going up forever.
It's crazy,
It
right?
does sound a little like
Yeah.
those Beady Baby collectors.
Oh, yeah.
You thought they'd be millionaires someday.
Exactly, yeah.
I know a few of those.
Well, the point is that emotions can make people do some pretty wild things with their money.
That's true.
And this book helps you recognize
Right.
those patterns so you don't fall into the same traps.
And that brings us to another big myth that the book tackles.
Okay.
A lot of people think that you need to be some kind of financial guru
Oh, right.
to invest successfully.
Yeah.
What does the book say about that?
Well, the book challenges that idea head on.
Okay.
It provides evidence that even professional investors, who try to pick stocks, often don't beat the market in the long run.
So if these so-called experts aren't always winning,
Mm-hmm.
what are everyday people like us supposed to do?
Well, the book lays out 5 simple rules for investing.
Okay.
They're called the 5 asset allocation principles, and they're like a roadmap for managing your money, no matter how old you are or how much experience you have.
Okay, let's hear about these principles.
Yeah.
Which one is the most important in your opinion?
Well, they're all important, but principle number 2 is especially powerful.
Oh.
It says that the longer you hold on to an investment, the less risky stocks become,
Interesting.
which is great news for younger investors because they have more time on their side.
So you're basically riding out the ups and downs of the market over time.
Exactly.
Okay, but what about those of us who don't have decades to wait?
Well, the book has a solution for that too.
Okay.
It's called dollar cost averaging.
Okay.
Basically, you invest a set amount of money at regular intervals, no matter what the market's doing.
So instead of trying to time the market perfectly,
Yeah,
you're averaging out your purchase price over time.
exactly. Yeah.
It takes the guesswork out of it.
Hmm.
Helps you avoid making emotional decisions.
And the book also talks about the importance of rebalancing your portfolio. This means making sure your investments stay aligned with your risk tolerance
Okay.
as you get closer to retirement.
All right, so we've got long-term thinking,
Yeah,
dollar cost averaging, and rebalancing.
that's right.
This is starting to feel a lot less complicated than I thought it would be.
Yeah, you're getting it.
Yeah.
And there's more.
Okay.
The book has a whole section on this really awesome investment called index funds.
Oh, I've heard about index funds.
Yeah.
They're like baskets of stocks that track the whole market, right?
Right, yeah. Instead of trying to pick individual winners, you're betting on the overall performance of the market.
Right.
And the data shows that index funds tend to do really well over time.
Okay.
Plus, they're low cost and tax efficient, which is a big bonus.
Okay. That sounds pretty simple and effective. Sign me up.
Now, for those who still want to try their hand at picking individual stocks,
Okay.
the book does offer some guidance.
Let's hear it.
Okay.
What are the secrets to picking winning stocks?
So the book outlines 4 basic rules, but the most important one
Okay.
is to focus on companies that have real potential for growth, not just hype.
Right.
You want to invest in companies that can keep making money for years to come.
Makes sense. You don't want to put your money in a company that's just a flash in the pan.
Exactly. And another important rule is to avoid trading too much.
Oh, okay.
All those fees and taxes can really eat into your profits.
It's amazing how this book, which was written quite a while ago, still has so much relevant advice for today's investors.
Yeah, it really speaks to the fact that some investing principles are timeless.
Right. Wait.
And that's what we're trying to do here.
Mhm.
Distill those essential truths that can help you build a solid financial future.
I feel like we've covered a lot of ground already. We've talked about market psychology, debunked some common investing myths, and explored some practical strategies, but there's still more to learn from a random walk down Wall Street.
Yeah, there is.
We'll pick up there next time.
Sounds good. So far, we've talked about some general rules for investing, but what about creating a plan that's just right for you? A random walk down Wall Street also has some helpful guidelines for that.
Yeah, it makes sense that we need different approaches depending on like our goals and how much risk we're comfortable with.
Exactly. The book stresses the importance of understanding your own needs.
Okay.
Like, are you saving for a house, for your kids' college, or for retirement?
Right.
Each goal might require a different strategy.
So it's not one size fits all. You need to figure out what you're aiming for first.
Right. Once you've got your goals in mind, the next step is to figure out your risk tolerance.
Okay.
Some people are okay with big swings in their investments, while others get nervous when things get a little shaky.
It's kind of like riding a roller coaster.
Yeah.
Some people love the thrill, and others would rather stay on solid ground.
It's like a great analogy. The book emphasizes that there's no right or wrong answer when it comes to risk.
Okay.
It's about finding what you're comfortable with, both financially and emotionally.
I imagine age plays a role too. Younger people might be more willing to take risks because they have more time to recover if things go wrong.
You're right. That's why the book has a section called the Life Cycle Investment Guide.
Okay.
It offers different strategies based on how old you are.
Gotcha.
For example, younger investors can be more aggressive because they have time on their side. They can focus on stocks, which tend to grow faster over time.
But as you get closer to retirement,
Yeah.
you might want to shift towards safer investments like bonds.
Precisely. This guide helps you adjust your portfolio as you move through different stages of life.
Okay.
It's all about finding the right balance between growth and stability.
This life cycle guide sounds super helpful.
Yeah.
Can you tell us a bit more about how it works?
Well, the book dives into the specifics for each age group, but before we get into that,
Yeah.
there's one more golden nugget I want to share.
Ooh, I'm always up for some golden nuggets of wisdom.
This one's about the power of saving regularly.
Ooh.
The book emphasizes that even small amounts, invested consistently over time, can grow into a significant nest egg.
It's like the old saying, slow and steady wins the race. But in this case, the prize is financial freedom.
Couldn't have said it better myself.
Yeah.
Even if you can only invest a little each month, do it.
Right.
Consistency is key.
Gotcha.
You'll be amazed at the difference it makes in the long run.
And don't forget about the magic of compounding.
Oh.
Your money earns money, and then that money earns more money.
Exactly.
It can really snowball over time.
Absolutely. The book shows how a single dollar invested in stocks back in the early 1800s would be worth millions today thanks to the power of compounding.
It's mind-blowing to think about. So we've talked about thinking long-term, saving consistently, and understanding your risk tolerance. Those seem to be the key ingredients for building a strong investment portfolio. But what happens when you finally reach retirement? How do you make sure your savings last?
That's a great question, and it's one that a random walk down Wall Street addresses in detail. Okay.
It discusses several strategies for managing your retirement nest egg, including something called life cycle funds.
What are life cycle funds?
They're funds that automatically adjust your investments as you get closer to and enter retirement.
Okay.
Think of it like having an autopilot for your portfolio.
Gotcha.
As you get older, the fund gradually shifts from riskier investments like stocks to more conservative ones like bonds.
Sounds pretty convenient.
It can be a great option for people who prefer a hands-off approach. The book also talks about annuities, which are a type of insurance contract.
So with an annuity, you pay a lump sum up front, and then the insurance company pays you a fixed amount every month for the rest of your life.
That's right. It can be appealing for folks who are worried about outliving their savings because it provides a guaranteed income stream. But the book also mentions some downsides. For example, annuities can be inflexible. and inflation can eat away at the value of those fixed payments over time.
So it's important to weigh the pros and cons carefully.
What other options are there for managing retirement funds?
Well, the book also discusses the do-it-yourself method,
Right.
which means managing your own investments. It can be a bit more challenging, but the book provides guidance on creating a withdrawal strategy.
Oh,
It suggests withdrawing about 4% of your total savings each year.
4%. That seems pretty low. Wouldn't you miss out on potential growth by taking out so little?
It might seem that way, but the book argues that this approach, combined with a diversified portfolio of stocks and bonds, gives you a good chance of not running out of money, even if you live a very long life.
Wow, that's reassuring.
Yeah,
So even in retirement, diversification and a long-term perspective are still important.
absolutely. A random walk down Wall Street reminds us that no matter what stage of life you're in, the principles of smart investing stay the same.
So it sounds like there are a few different ways to approach retirement investing,
Yeah,
each with its own pros and cons.
right.
What are some of the key things people should consider when deciding which path is right for them?
Well, it really comes down to your individual circumstances and comfort level.
Okay.
Life cycle funds are a good fit for people who want a simple hands-off approach.
Mm-hmm.
If you value guaranteed income and peace of mind, annuities might be worth exploring.
Right.
But if you're comfortable managing your own investments and want more control,
Yeah.
the do-it-yourself method could be a better option.
It seems like a random walk down Wall Street
Yeah.
really emphasizes the importance of having a plan,
Oh, absolutely.
no matter which approach you choose.
Yeah. Having a clear strategy helps you stay on track and make informed decisions.
Right.
It can also help you avoid making impulsive moves based on fear or greed,
Okay.
which can be detrimental to your long-term financial well-being.
This deep dive into a random walk down Wall Street has been incredibly insightful.
Yeah, it has.
We've covered so much ground, from understanding how markets work to building a solid investment strategy for different life stages.
It's been a pleasure unpacking these concepts with you. Hopefully, our listeners feel more confident about navigating the world of investing.
I think the biggest takeaway for me is that investing doesn't have to be complicated.
Right.
It's about sticking to some basic principles, being patient, and making informed decisions.
I couldn't agree more.
You don't need to be a financial expert to build wealth over time.
That is the truth.
So to our listeners,
Yeah.
if you're looking to learn more about investing in a way that's easy to understand and packed with timeless advice, I highly recommend checking out A Random Walk Down Wall Street.
It's a classic for a reason.
And remember,
Mm-hmm.
the journey to financial freedom starts with a single step.
Well said.
Thanks for joining us on this deep dive.
Appreciate it.
We'll catch you next time.
See ya.